Hello, everybody. Welcome to episode one of the CRE Showcase series. Today we are speaking with Cameron Dively. He's with Historic and New Market Tax Credits. He's going to teach us all about how to make money on those old buildings. Hey, Cameron, how's it going?
I'm doing great, Mary Jane. Hope you're doing well and excited to pass on a little bit of knowledge here on historic new market tax credits and how they're just wonderful tools for both new and experienced developers to bring extra equity dollars to projects, fill in gaps, and just really make projects pop.
Awesome. Let's get going. All right, so introductions. I'm just going to introduce myself very quickly. My name is Mary Jane Karimi. I'm with Cunningham Ventures. I've been doing commercial real estate for about 6 years now. I do industrial, retail, office, biotech, land development in the Houston market and around in Texas. Uh, and then we have Cameron.
Yeah. So I've been in I'll say structured finance, project finance for about 8 years now, primarily focused on new market tax credits and historic tax credits. A little bit of experience in some other areas, but the vast majority of my time has been focused on those two buckets. I've been with Grove Community Development Capital since its inception, which is about 8 years ago. I helped found the firm, and really our focus has always been on just guiding, our clients through sort of the soup to nuts, how to do a tax credit transaction, how to pursue the credits, how to plan for them, how to close on those credits, and then managing sort of the process afterward, the compliance life cycle for those tax credits. I'm a graduate from Carnegie Mellon University, where I received a BA in Ethics, History, and Public Policy, and then just recently graduated from the Indiana Kelley School with my MBA and an MS.
Congratulations.
Thank you. So, first question people often ask us is, well, why historic tax credits, right? So, historic tax credits are an excellent tool in the toolbox of a modern developer because costs of construction generally, and in particular, rehabilitation costs for existing structures instead of new build, are quite high. They're not coming down. There are almost always unforeseen conditions. Once you start cracking open the walls, you're going to find asbestos. You're going to find problems in wiring. You're going to find lead paint. You're going to find something that's going to require remediation. And there's just work that needs to be done, even if it's just normal shoring up of walls and work on the foundations. All of that comes to mean that these projects are more expensive, they're more difficult to finance, always end up ballooning more than you would expect. Historic tax credits allow you to take away the concern, the edge that's brought in by working on an existing building. There's lots of benefits to using an existing building. A basic one just being they're often gorgeous. They have history. They're landmark buildings that are going to be eye-catching, but they're often just very, very daunting to take on as a developer. Historic tax credits eliminate a lot of that concern and risk. And if you want to look at it from a dollar perspective, they're going to generate a higher rate of return because you're going to be reducing that overall cost. You're bringing in an equity injection. It's not debt. It's going to allow you to really just get better LTV results with a lower cost of capital. Quick history on the program. Since its inception, which came out about during the 1970s, more than 40,000 buildings have used historic tax credits to be relevated or rather to be renovated. It is not a niche or arcane program. It is used by developers across the country, large and small, with great effect. It is arcane in the sense that there are a number of hoops that need to be jumped through. They're not particularly complex usually, but they can be onerous to have to learn about. That is what my job and others like me as project finance consultants, we're here to shoulder a lot of that burden, deal with that headache, and guide you through the process so you can reap the rewards without having to take on really much, if any, of the headache. That's our job. So I've been saying, historic tax credits a lot. Here's, well, what a tax credit is and how the program functions. The federal income tax credit, which is the FHTC, the federal historic tax credit, is equal to 20% of the expenditures, eligible expenditures, uh, on a historic rehab project. It's officially completely earned once the property is placed in service. The HTC itself is claimed by the owners of the project, including third-party investors. That's going to be important here for a moment when we get into the actual investment structure. The Texas state program, many states have their own state programs that piggyback off of the federal program. Texas has probably the best state program in the country in that it is 25% of eligible expenditures stacked on top of the 20% you're going to get from the federal government. So you're going to be getting a 45% tax credit. Now that's a dollar for dollar. That is a just a dollar credit. You could save that for yourself to offset some of your own income tax liability, but unless you have millions of dollars of income tax liability per year, it makes a lot more sense to sell these credits to a investor, typically a large bank, for somewhere between 65 to 85 cents on the dollar. Now that term sell is it will change in its application. For the state program, it is a certificated credit. You can be bought and sold like a loaf of bread. Very easy. The federal credit, not so much. So you might have heard me remember that it can really only be claimed by owners in the project. So investors have to be brought in as essentially part of the ownership structure in order to claim that credit. And that is one of the things we do is help provide a lot of that financial structuring and advice and working around how to bring in these outside investors that want simply to acquire the credits and provide the equity in return, how to layer them into your ownership structure so that you're not actually giving up control of the property. You're just utilizing the tax credit program for the economic benefit. So, how do you qualify for the program, and really what costs are eligible to really serve as the basis, that qualified rehabilitation expenditure that I mentioned? So, that 20% calculation, it's based on qualified rehabilitation expenditures or QREs. That is really going to be anything related to the rehabilitation of the property and a variety of other costs. Pretty much anything other than FF&E and a couple of other smaller items. Some soft costs can be caught in there as well. Um, Good way to think of it is if you picked the building up, turned it over, and shook it, anything that didn't fall out is going to be an eligible QRE cost. In most projects, that's going to come out to about 80 to 85% of your total project costs will be QREs. Now, in order to be eligible for historic tax credits, first and foremost, the project must be on the National Register of Historic Places. It doesn't have to be there when you buy the project or buy the building, though. You can have the building placed onto the National Register. In fact, that's how most historic rehab projects using historic tax credits take place. There's a three-part application process. The NPS, National Park Service, Part 1 application is the application to have the building placed onto the National Register. The Part 2 is where your plans to renovate the building are reviewed at the National Park Service. And if you're doing the state program at the State Historic Preservation Office as well, they will review your plans and make sure that your renovation construction drawings are in keeping with the historic rehabilitation guidelines to ensure that the historic nature of the building and its critical elements are not being disrupted or disturbed. Once you get approval for that, you're good to close. You're able to begin your construction, and then the part 3 is going to be received once your building places in service. It's been fully completed. A representative from the NPS will show up, take a look at your building, confirm that you did in fact follow the plans that you had submitted, and basically, give you an A plus, and you earn the rest of your credits. Your building is officially completed, and you've gone through the historic tax credit process.
How much does that usually cost?
So there's two types of consultants on a deal like this. The first one, which is not what I do, is what's called a preservation consultant. And they're typically going to be around ten to $15,000 as a bit of a flat fee. Their job is to complete these NPS forms. They interface with the National Park Service and the State Historic Preservation offices. They will do all of the research, which is quite extensive, to argue whether your building should be placed on the National Register. And that typically involves combing through copious historic documents, newspapers, radio, anything that where they can find references to the building, where they can argue why it is historically relevant either to the local community, to a particular racial, religious, or social group, to the fabric of America. It is an important architecturally, is it important socially? They will come up with arguments as to why this building ought to be considered important and ought to be placed on the historic register. That's a lot of work. It's a fairly niche field. That's what a preservation consultant, first and foremost, is going to do. Once they've done that and you're at the point of you've submitted your part one, you have the approved part one, you're chasing the part two, you're getting your plans drawn up, you're forming up your capital stack, that's where we step in. And we are typically going to be charging our fee on a success basis, where once we come in, you pay a nominal retainer, and then we just work for you until closing. And then we'll take a small percentage, typically 1% to 2% of the total historic tax credit amount.
I
That's
see.
fair. That would be industry standard. The percentages might change, but typically 1% to 3% is going to be the accepted amount for a project finance consultant.
Great. Thank you.
Quickly revisiting again, what is a QRE? Most hard costs of construction, soft costs related to construction are pretty much all going to be in there. Professional fees. Most important one that's worth noting here is development fee. This is usually a bit of a sticking point on projects as a developer. You'll have to get a reasonableness opinion, usually determining, is your development fee reasonable? On projects, on historic tax credit projects specifically, there's a little more lenience given to development fees. They can be pushed, as much as 10 to 15% of the overall budget because it can be captured as a QRE, which means it can generate that 20% credit. The investors like to see higher developer fees because it means they're getting more credits, which is all they care about. And all the parties involved recognize that and accept that. So this is one instance where you might see higher developer fees than is maybe typical in projects of similar size and scope that aren't using historic tax credits. And then things that aren't QREs, like I said, cost of the acquisition costs, new building. If you're building an addition, if it's not the historic structure, that's not going to be eligible. FF&E, personal property, that kind of thing. So this is just a very quick and easy way to visualize back of a napkin. How do you get to the benefit of actually, at the end of the day, what are the dollars you're getting for utilizing historic tax credits for going through some of this headache? Well, if you have a $15 million project, $10 million of that is going to be QRE eligible. You get a 20% credit on that, so that's $2 million. You're building this in downtown Houston, so you're going to get a $2.5 million credit from the state. Let's say you've hired Grow, we go out and find an investor. That investor is going to pay 80 cents on the dollar. Usually it'll be slightly lower for the federal credits, slightly higher for the state. But for ease of calculation, we'll say it's 80% flat or 80 cents flat. That means the investor is going to bring in about $3.5 million of actual cash. They're going to contribute that to the capital stack. In return, they're getting your $4.5 million of credits to offset their own income tax liability. Making assumptions on closing fees, attorney's fees, our fee, the investor's attorney fees, etc., accounting fees, let's say $400,000, you're going to net out after all of this a little over $3 million, which at the end of the day, $3 million on a $15 million project, that's quite significant. That's $3 million you don't have to either get it in the form of a loan or raise yourself as owner equity. So, quick rundown on HTC sponsor planning, sponsor being the developer. If you're considering pursuing historic tax credits, first and foremost, confirm whether or not your project is eligible for historic tax credits. Is it listed on the historic register? If it isn't, get a preservation consultant, have them take a look at the building and say, do we think we could get this placed on? Once they do your is what you want to use the building for. Can you make those changes while still conforming to the guidelines for rehabilitation? If you have to start knocking out interior walls or significantly change the facade, or if you have to put in windows, all of that can be difficult to do because it will damage the historic nature of a building. This is why it might be difficult to turn old warehouses into a hotel. If there are no windows, you can't knock holes in the wall to put in windows because that would destroy the historic nature of a warehouse. However, if you move through that point, you work with your preservation consultant and your architect are familiar with these limitations. Once they reach a point where their plans they feel will pass approval at the state and federal level, they submit for review. They are reviewed and approved. Then it's just a question of getting the rest of your capital stack in place, figuring out your senior debt and any other sources you might be pursuing, such as CPACE. Then our main job, beyond helping you with that initial planning and structuring, marketing the project to investors, maximizing both price and pay-in schedule, as different investors will bring in their equity in different degrees. So maximizing and finally tailoring that process to best fit whatever the needs are for the developer, and then coordinating the closing process, which can be a little complex, but we're expert in it, and that's why it's having a project finance consultant on your team during that process is very helpful. Helps keep attorney fees down. Now, I didn't mention this earlier, but the tax credit is earned over 5 years. So this financing structure will need to stay in place for 5 years after the building is placed in service. Once you've moved through that compliance period, then there's an unwind, and that structure can be dissolved. However, the caveat there is we can't unwind that before those 5 years are out. So if you wanted to sell the building or refinance, there is an SNDA, forbearance agreement, or a forbearance agreement in place where you'll have to work with your tax credit investor because they have a vested interest in seeing this building stay in operation and continue to produce those credits for them. They will need to sign off on those plans. You can do it. You'll just have to work with that investor if you're within that 5 year period. Pausing there for any questions on the historic tax credits before I move on to the new markets.
So we did have one question. Somebody was asking, so does the investor get paid over the 5 years, or does he get paid in a lump sum at the beginning?
Good question. So the investor is going to input their equity typically in 3 stages over the course of construction. They'll put in a portion at closing when the deal and the financing closes, some other portion at milestones throughout construction, and the remainder when the building places in service. There's no set formula. It's really up to the preferences of each individual investor. They will receive their credits. They're going to earn their credits over 5 years. That's one reason why for a $1 credit, they're paying 80 cents because of the time value of money. They're paying today for a tax credit they'll receive 3, 4, 5 years from now. That's also why there'll be an SNDA, a subordination non-disclosure, or a forbearance agreement in place to prevent the disruption of this structure that's generating their historic tax credit for them for the next 5 years, because they don't want that to go away because now they've paid for something and now they can't get it. So they will receive their credits in 5 or 4% increments over 5 years, but they're going to pay for it all up front.
I see. Thank you.
Absolutely. So turning now to a similar but also dissimilar program, the New Market Tax Credit. The historic tax credit is focused on historic buildings. It is by right. If you jump through the hoops, you get the credit. The new market tax credit is a little more niche. It's a little more finely tailored, a little more difficult to get, but a great addition to any uh, project's budget. This legislation is intended to focus on projects in low-income communities that are having really strong, clear community impacts, bringing, well, we'll move on. I'll show you. These are really intended to bring investment dollars into communities that have historically not seen a lot of investment, that are low income, and that is an actual term. It's not just an adjective. There's a threshold for what it means to be low income, either by virtue of AMI, area median income, unemployment rate, or poverty rate. If any of those are high enough, then you will be qualified as low income, and projects being built in that census tract will be eligible for the new market tax credit. Now, I said the new market tax credit is finite. Uh, $5 billion of tax credit allocation of basis is announced each year by the CDFI fund, which is a division of the US Treasury. Those funds are distributed across a tapestry of entities called CDEs, community development entities. These are middlemen, community organizations, banks, etc., that have a clear mission and focus to deliver these dollars to some form of community good. Some of them are national in their scope. They will do projects in any state, and they might only do hospitals. Others are very locally focused or state focused or regional focused and may look at manufacturing and quality job creation or charter schools or workforce development training facilities. That tapestry will then, each CDE gets to decide on projects within their scope that they would like to award those dollars to and bring that additional new market tax credit equity into those specific projects. So, quick review of eligibility. Are you a eligible business project, which would be, again, do you have a noted community good that can be tied to your project as a commercial project? Are you located in a distressed census tract? If you have those two things, you're eligible. Now it's just a question of, do you have a strong enough community impact that you can compete against all the other deals out there that also want a slice of this rather limited pie? And- But let's say that you've been successful in arguing for, let's say the city of Houston has a CDE. They won an allocation award, and you have been able to successfully lobby them to provide an allocation. They provided you with $10 million of allocation. Well, the new market tax credit, the actual credit is a 39% credit based on that allocation. So unlike the historic tax credit where it's 20% of your QREs, here it's 39% of your allocation. So the more allocation you're able to secure, the more tax credits you're going to generate. On a $10 million allocation or basis, you're going to get $3.9 million of credits. Then an investor comes in. Pricing on this is a little more static. It'll be somewhere between 75 to 82 cents typically. Going for the low end here, 75 cents on the dollar. The investor, in this case, let's say PNC Bank, is going to bring just about $3 million, $2.9 million of cash equity into the deal in exchange for those $3.9 million of tax credits. Less various closing fees, and that includes CDE fees. A facet of this program is that the CDEs take about a 4 to 5% haircut off the top fee for themselves. That's by design so that they can take those dollars and use it in their good works that they're doing in the community. So you see, that's almost $1 million in fees. About half of that is going to be going directly to the CDE. The remainder are accountants, lawyers, etc. But that will still net out $2 million to the project. And that's a good rule of thumb, is about 20% of your allocation is what you're going to net out as equity at the end of the project. Now, the new market tax credit is a 7-year compliance period. Very similar to the historic tax credit, which was a 5-year period. Here, that 39% tax credit is earned over 7 years. So the same types of restrictions are going to apply. This financing structure will need to stay in place over that 7 years. Once it's over, there's a put, and you unwind the structure. We can get into the details on that if people are curious about it. The new market tax credit is program. The actual structure is structured as a loan that the sponsor will inevitably forgive themselves. It's done that way for tax purposes. Uh, at the end of the day, the cash is coming in. It's $2 million of extra money. It's not a loan, but it is structured as a loan. So if you're considering new market tax credits as part of your capital stack for a project, the kind of main steps to remember are going to be make sure you check first and foremost, are you eligible? If you're in an eligible census tract, you're good to go. Then it's just a question of beefing up those community impacts, making your project attractive to other CDEs that might want to consider your project, but also are going to be looking at other deals. And you have to make sure you can beat those other projects at how impactful you're going to be. The transaction funding structure is going just to be more complicated than the historic tax credit one. There's a little few more moving pieces. That loan structure that isn't a loan can be quite complex. We would recommend having a finance consultant along for the ride, assisting with this, not just on the structure side, but also chasing allocation. There's no guarantee you're going to get it. It requires a lot of shoe leather and sweat to just dial for dollars, spend time on the phone, talk with CDEs, figure out what they're looking for. That's a very large part of my job. And you, as a developer, likely have far more important things to do with your time than calling a tapestry of CDEs and trying to figure out what they're looking for. And then lastly, that closing process, likewise, it's going to be a little bit complex. A lot of very niche parties, moving pieces. It's useful to have a consultant who's experienced with that in the room herding the cats. And then the obligations to remember, it's a 7-year compliance period. Um, There'll be a community benefits agreement. I didn't mention that earlier, but that is effectively a document where you will submit a report each year on the positive impacts that your project has brought to the community each year once it's built. Because those are the impacts that the CDE that provided allocation is interested in, they want to see that you actually are doing the things you said you would do. So each year you will submit, or your tenants will submit, if you've leased your property to a daycare or a hospital, they will submit a document that just outlines those impacts. It's usually very short, 2, 3, or 4 pages, and then the CDE will deliver those back up to the Treasury and say, "Hey, look at what I did with that money you gave me, with the allocation you gave me. Please give me more." I was a responsible steward of that allocation. I helped support these amazing impacts in these amazing communities. I want to keep doing that. Please provide me more allocation in the next round. And then the last things to remember again, the put option and the unwind, those are going to be rather complex. They're straightforward to us. They're complex if you're on the outside looking in. Would recommend also having a consultant in the room to help you walk through that as well.
What's the timeline from start to finish to get money from CDE?
So this is one where you cannot start too early marketing your project to CDEs. The new markets program, it's cyclical. Each year awards are announced sometime. I used to say sometime in the summer. Keeps moving back each year as the government becomes a little bit less efficient at reviewing things. So the awards actually for now were just announced in December. And the projects most likely to be funded with the proceeds of that award are going to be deals that were included in the winning CDE's applications last year around the same time. So applications for this round were due back in January of 2025. And then the CDEs that won, the first deals they're going to look to do are the projects that they highlighted in their application because they get bonus points for that. So that means really you want to be almost a year and a half to 2 years ahead of your expected closing date. You would ideally be putting your hat into the ring, talking to CDEs, getting your project into people's pipelines. That's difficult to do sometimes, but usually it's going to take anywhere from 6 months to a year of marketing a client's project before we secure the allocation and move to closing. It's a very competitive process. CDEs don't like to make their decisions quickly. They like to really dig in and underwrite deals before they make a call. So the more time we have to sit down with CDEs, to talk to them, to promote a client's project, the higher the likelihood we have of actually securing that very limited resource.
Great. Thank you.
Actual closing is quite quick. Once you get the allocation, it's typically only 60 to 90 days, sort of a typical uh, closing for a non-traditional financing structure, PACE or anything, 60 to 90 days. And then that's it. Happy to, stay and take questions, but just really thankful for Mary Jane for having me on. And, I always enjoy talking about these projects. These programs, they're wonderful. They're great tools in the toolbox. There's my contact information as well as the contact information for my company's president and CEO. If you have any questions or you have a project you'd like to explore, give us a shout.
Fantastic. Thank you so much, Cameron. We did have a few questions during the segment. I know that, are you based in Houston?
Yes, I'm based in Houston. My colleague is in Pittsburgh, and we are national in our scope.
Perfect. That's exactly the question. Um, and then the other question that I had from somebody in the audience was, are you able to add on to a historical building?
Mm.
Would that be considered part of the renovations?
It's a great question. It's a case by case basis. So let's say you want to put an add-on to a building and it's in the back and you can't see it from the street and it's not going to mess with the facade. Then you might be fine. It wouldn't be really considered as being a problem. However, if you were adding on substantively to a existing historic building and it's going to obscure much of the facade or the building itself, or it's going to in some way destroy maybe an iconic skyline. If you build on top of the Flatiron building, that might disrupt the historic fabric of that building. A lot of that is going to be up to the determination of the National Park Service. And this is where having a preservation consultant who is really, really finely versed in those historic rehabilitation guidelines. And I say guidelines because there is gray on almost all of them. There's room to wiggle and give. They will be your strongest advocate to the National Park Service and try and push through the things that you need. So even if they can't get everything, they can usually be good at getting you, yes, you can add on to your building, but you'll have to abide by this restriction or that restriction.
Right. Well, thank you so much, Cameron. This has been extremely educational. And for any of you viewers out there who need help with your historical buildings, feel free to give Cameron a call or an email. And as always, if you're looking for commercial real estate, buying, selling, leasing, here I am. Give me a call. Thank you so much, Cameron.
Thank you, Mary.